Welcome to Scottish University, Module 2, Lesson 4, Execution. This lesson is all about the actual act of entering, remaining in, and exiting a trade. There's more to it than people think, but like everything with good trading, it's sticking to the basics and keeping it simple that provides the highest probability of consistent success. So first, I define trade execution as every action taken and not taken from the moment you begin to plan a trade until you fully exit the trade. So what that means is everything you do before, during, and after, but probably more importantly, things that you don't do during and after. So an example of that would be overtrading is a common term. So anyone can enter a trade and put their stop loss down and be in a position because the system, their system and rules flagged a potential trade. But if you sit watching the trade and allow the green and red candles shooting up and down to affect your emotions, you can make bad decisions such as closing a trade that you think is going against you, which then ends up reversing and going in your favor and you lose out. Or keeping a trade open too long, even though you know that you should let it hit its invalidation, or if it hits invalidation, that you exit. So every action taken and not taken from the moment you begin to the moment you exit. Execution comes in two parts, the core and supplementary. So core is the mechanical act of executing, and the more supplementary factors are the discretion that you must have as a trader in any trade. So rule number 30 relating to execution is minimize discretion and maximize mechanical. So the core elements that I talked about, to enter and exit any trade, you only need to focus on three things: the entry, the stop loss, and the exit. And especially for new traders, we want to minimize discretion and maximize this mechanical action. So number one, the core element, you want to maximize that, really focus on that. Even for experienced traders, this is the best way to frame your trades, especially if you're testing a new system or just best practices. Now, you do also have supplementary factors, which are the discretionary element, such as closing a trade early, extending a trade beyond where you were originally going to, cutting it after the execution, so you enter the trade and you cut it early, or you cut it immediately, not taking a trade per your system, so you get a setup, but you decide not to take it for whatever reason, and things such as scaling in and scaling out of a trade. So that relates to how much you enter. Do you enter it all at once? Do you enter in chunks, in thirds, quarters, halves, whatever? They all fall into discretionary. They're all things that you do not have to do to have a successful trade. Now, as you become more experienced, some of those can make you a better trader, but equally they can make you a worse trader if you don't dial in the basics first. So what you should always focus on to begin with are the core elements. Focus on entering when your system tells you to, setting your stop loss and your invalidation with a hard stop, meaning you put a market order on the exchange to exit if it hits, and having a profit target that you don't move. Again, you have a take profit order and you let it run, and the trade either runs to completion or it doesn't. So let's dive a little bit deeper on that and break down the mechanical side of trading. So we talk about mechanical action. It comes to rule 31, which is start with the stop. So you can see here a quote that I put in HU about the thought process you should be having before you place a trade. You should be saying, where am I wrong? All right. That means before you even consider hitting the buy or sell button on a long or a short, you need to figure out, if it goes against me, Where is my idea invalidated? Where am I wrong? Then, after you place the trade, you ask yourself again, now where am I wrong? When the trade plays out for a few minutes or a few hours, whatever you're trading, but for us as scalpers, probably after a few minutes, and the market moves either in your direction or against you, you continually ask yourself, now where am I wrong? Is it the same place? Then you leave your stop loss where it was. Is it a new place? Then you move your stop loss. And after the next move, let's imagine you're in a long and it goes in your favor, so price pumps. Once it has pumped and maybe broken a new high, you ask yourself, okay, now where am I wrong? And you just repeat that all the way through your trade. It's not good enough to just enter a trade and say, here's my entry, here's my exit, and I'm just going to, not take on the new information that the market's giving me. You should always be at least asking yourself, what has happened since I placed this trade? What has happened since I last updated my invalidation or whatever? Right, so in terms of that, the biggest focus with that is to start with your stop. So in a mechanical sense, you need to have a stop loss set that would be at a level that invalidates your trade. A common mistake I see people make is they set their stop loss to an arbitrary percentage figure below the price. So they say, I'm going to enter at 40,000 on Bitcoin and I'm going to put my stop loss 1% lower. That's not the correct way that's not good risk management for a start, and that's not mechanical execution. You can't just say, oh, I'm going to place the stop loss 1% below, and that's a good strategy. Your strategy should be based upon market structure, meaning if it's a long, your stop should go below a low that would indicate a trend change. Rule number 32 is to remove the human element. All right, there's a number of factors within this, which are calculate R to the logical target. For me personally, if it's greater than 2 to 1, I consider that a valid trade, meaning if I risk $1, I stand to win $2 or more. Calculate the position size based on the R that you just calculated and your portfolio balance. Enter using limit orders, which is best practice. Your stop loss is always a market order, and your take profit should again be a limit order with reduce only. We'll break all of those down individually, so don't worry about me running through them relatively quick. I'm just giving a summary. So we want to jump now into a bit deeper into Rule 32 and the first part, which is the calculating R to the logical target. You can see here with this example. Now, might look confusing at first, but we're going to break this down fully. So, first of all, what we're looking at here is a long setup. Okay, the white line represents the low that has been run. So the price has swept down through the low, collected some stop losses, and then bounced back up. The dashed red line is the market structure break, which is, if you see where my cursor is, you can see it's the high. This up candle, this blue candle, is the high which produced the down candles that broke the low. When you break back above that, which would be here, because a wick above doesn't count, we then went firmly above, then you're going to start looking for a long, potentially. Where does that long originate? Well, it will originate somewhere between the market structure break, the dashed red line, and the original low that got ran, which is in green here as the buy zone. There'll be more on this in the in the price action module, which talks about the under-over pattern, which is what we're seeing here. Reverse head and shoulder, inverse head and shoulders, you could say. Shoulder, head, and we're looking for a shoulder to form. And I've marked out 2 potential trades. So this is what you should be doing live in the moment. So when price is chopping around up here, you should be planning out some trades and seeing, is there a potential 2-hour trade or more? Before you even, if you don't have that, then you can't enter. Okay? So I've took 2 examples. First, you want to find your target. So the target, if you're ever taking a long, it should always be some type of key high. Because what are you looking for? You want to enter when people are getting stopped out, and you want to exit when people are getting stopped out. So in this instance, if you're taking a long, you want to exit above a high where you know that some shorts are going to get squeezed out. So we've broken back above here, so you know that it's a valid trade, and if you do get this set up, you can take a long. So what you're going to look for is a similar pattern, which is setting a low here, then sweeping that low like we do, then breaking back above. So you could enter here if you want a single confirmation, or you could have entered here if you wanted the double confirmation, here on the white line, because that's like what you call a perfect retest, where you have almost exactly to the line where it hits, so it forms almost a perfect right shoulder. The main thing is you're entering somewhere within this buy zone, you're dragging your stop loss tool down to the low where you're invalidated, you can see your invalidation, and you're dragging your profit up to the target. And you can see here 2.2 for this one. So if you just entered here at this exact point when price dropped down, you could potentially have a 2.2 trade if it hits target. If you waited and you entered here on the perfect retest, you could have a 3.1. So both of those are above 2R, as you can tell. Therefore, this is a valid setup to take a trade. Now we can see, obviously, as the trade played out, it did end up hitting target. We broke up here aggressively, and you would have made a successful, profitable trade. But you must start with the stop. So the whole purpose of this is that you drag down to here, you find out what is the risk you're going to take, then drag up and see what's the potential reward. If it's over 2, for me personally, if it's over 2, I will take the trade. Other people, you may vary. You might take anything over 1. Some people take 1.5 or more. Some people take 3. It all depends on how you trade specifically. This course is about learning how to scalp from scratch, basically. And I advise that the best starting point is to stick with 2R or more. That means you can have 2 winners for every 2 losers and still break even. Oh, sorry, 1 winner for every 2 losers and still break even. Excuse me there. Every time you have a winner, you make 2R. If you have 2 losers then in a row, you're back to even. So this system lets you get away with a 33% win rate and still break even. Then what you want to do is tweak and iterate and get, as you get better and more experienced, get that to maybe a 50% win rate if possible, and then you're making consistent profit. So calculate R to the logical target. Key points of that are: start with the stop and make sure your target is logical. You'll notice here there's no, I'm going to just put my target above 4%, I'm going to put my stop loss at 2%. There's none of that. It's all about the market structure. It's about the key highs and the key lows. So your logical target is the key high that the stops are going to be resting above up here. Your obvious, because you've broken structure, you've broken above this dashed red line, your obvious stop loss is down here because the market broke down. It then broke back up, meaning there's longs trapped here, shorts trapped here, or longs who have been stopped out. So the market should reverse and squeeze them. Now, once you've done that, you need to calculate your position size based on R. So the R that you had dictated, and I've taken away all the noise out of that last chart, and we're using the second example, and I've just zoomed it in and made it a little bit more clear. This is how you actually calculate the exact position that you put on. Biggest misconception I see with position sizing, again, is that people think you should put a fixed percentage of your portfolio or a fixed percentage in price as the stop loss. So you hear me talk about, I believe 1 to 2% of your total portfolio is how much you should risk on each trade. That does not mean that you enter and you put your stop loss 1 to 2% below the price. You still put your stop loss below market structure, which is the red line. That's the same red line from before. And you can see on the right-hand side, I've detailed exactly how this trade would work. So when you have your setup like this, you take the entry, the stop loss, and the target. You get those figures, and then you calculate that based upon your portfolio size. So for example, if you have a $10,000 portfolio and you're risking 2%, that's $200 you're risking. Yes, 1% of 10,000 is 100, therefore 2% is 200. You take that 200 and you divide it by the distance between your entry and your stop. You can see on the chart here, that's 668 approximately, okay, $668. It has to move down for you to get stopped out. So you take 200, which is your portfolio risk, you take 668, which is your stop loss, and you divide those two numbers. That gives you a figure, which is 0.3. That is your position size in BTC. So if you put on a 0.3 BTC trade and you have a stop loss at that level and price hits that stop loss, you will lose $200, give or take. Small bit more probably if you factor in the fees from the exchange and everything like that. But you understand the mechanics and the basics of this, and when you do this a few times, you'll figure out your exact. You'll probably lose 204, 205 because of the fees and stuff, and then you can adjust and tweak. But I hope that makes sense of exactly how you should position size based on R. It's very simple, but it's something that's often misrepresented and often a common mistake I see. Stick with this and you won't go wrong. So we've covered the first two. Now to talk about the last three elements within the rule number 32. You should always enter using limit orders where possible. So because you're in a course about scalping specifically, I'm not going to patronize you by telling you what limit orders and market orders are. If by this stage you don't know what a limit order and a market order are, I would pause this course completely. I would not take any trades until you've thoroughly researched them and understand what they are. Okay? You should always enter using limit orders because they make you a more patient trader and they incur lower fees on an exchange. A limit order requires price to come to your level. Even if it's $1 below, it requires price to come down if you're going long, or it requires price to go up if you're going short to fill your order. A market order just takes the best price possible. Even just the way I described that would make you understand that a limit order is patience, a market order is impatience. Impatience is always bad as a trader. Now, you don't have to always use limit orders, but it is the best practice. So if we're trying to be mechanical traders, then we say we use limit orders. Okay? Or even if you want to be mechanical and you want to say that I always use a market order to enter, then fine. The main thing with that would be consistency, but market orders are going to give you a worse entry price and they're going to open you up to potential FOMO or fear, and they're going to also incur higher fees. Your stop loss should always be a market order, okay? Because when it comes to a stop loss, fees are irrelevant. Especially in a market like crypto, price is very volatile. You can get these massive candles down that liquidate traders for, $3,000-$4,000. Bitcoin has done 10K candles in a day. So your stop loss, if it hits, the number one thing you want to do is get out of the market. If you try to fuck around with stop limit orders, which is price comes to your level, it hits your stop loss, but it doesn't execute because it sets a limit order to then execute. So basically it has to go down through your price and bounce back up to hit your limit order. If it goes down through your price and just keeps going down, you're going to end up taking a loss way beyond your 1R or your 2% portfolio risk. So stop loss, always a market order. That's simple. I shouldn't even have to explain that. If that's the one rule you take from me that you just blindly follow, then just follow it. I've traded for a long time. I've always used market orders when stopping out a trade. The risk is not worth the reward of that little bit you save in fees by using a stop limit. Now, take profit should always be a limit order, set to reduce only. Again, if you don't know what reduce only is, you shouldn't be trading. But very quickly, reduce only means it will only reduce your position size. It won't open a position in the opposite direction. Okay? If you're in a 1 BTC position and it hits a limit order of, say you accidentally set a limit order of 2 BTC and it hits, it will close your position and open a 1 BTC position in the opposite direction. If you tick reduce only, even if you put in a 2 BTC limit order and you've got a 1 BTC position size open, it will still only reduce it and close your trade. So always take profit using a limit order, reduce only. That's mechanical action done. Simple. Simple, but it fucks a lot of people up. And this is where, well, what we're going to go on to next is what mostly fucks up people, which is the discretionary side. So, in terms of execution, there are discretionary factors. Discretionary trading, as the name would suggest, is all about your emotional and psychological control while trading. It's your mental approach to executing a trade. What do we know about mental approach, psychological, emotional? They are all words that do not align well with consistency. Okay, some people are god-tier traders with ice in their veins and a complete level head. I'm willing to bet that that's not you. And that's not me being mean. That's just the statistics bear that out. They talk about 90% of traders losing money. Gets thrown around a lot. The reason for that, and I say this over and over and over again, the reason 90% of traders lose money is not because the pattern didn't work or the indicator was faulty or whatever. They lose money because of poor risk management, which comes down to poor emotional control. They move a stop loss lower when they shouldn't, and they take more than a 1 hour loss. They get greedy, and instead of taking profit at their preset level, they leave a trade open and it ends up reversing. Things like that cost you both profit and loss. So, getting into the rules around discretionary factors. Rule number 33, every minute is a new market. Okay. This is the most important part of the discretionary element of trading. And this is something that you should always actually keep in mind, is that the market changing gives you new information. People tend to think that if you have a setup, like the one we showed a second ago, where you got a nice clean under over, they think that when you enter that trade, that's the trade. You know, you're in the trade and now it just has to go to your level. But every single minute, the market changes completely. Let's say hypothetically, you got a perfect long trigger, you entered it, price started off in your favor, and then suddenly there was a massive FUD news piece or a real black swan event like COVID that was completely unforeseen in terms of the market impact, and price just reversed and went down $3,000, $4,000 on BTC. There's nothing you can do in that instance. But it shows you that you only need 1 minute for the market to change completely. It only takes 1 minute to hit your profit. It only takes 1 minute to get stopped out. Every minute is a new market. So remain flexible. Don't think that just because you got a good entry that the trade's definitely going to win, or even if price is creeping down towards your stop loss, don't think that means it's going to hit your stop loss. Every minute is a new market. It can get right down $1 away from your stop loss and bounce. Happens up quite often. So remain flexible. Remember, constantly update your mental view of the market, which leads in nicely to rule number 34, which is bias, not prediction. Okay, so bias is a disproportionate weight in favor for or against an idea. Okay? So without getting too autistic, having a bias means you're never 100% black or white. You're never 100% right or wrong. You're never 100% bullish or bearish. You're never 100% sure that you're going long or going short. That's what a prediction is. You see this a lot. It's big on Twitter. All the talking heads, all the dickheads on YouTube, they predict constantly. Bitcoin's going to 200k. Bitcoin's going to zero. Whatever the crazy outlandish statements they make are. Predictions tie you to the outcome. If I go in to hate you, or if I post on Twitter and I say, I predict Bitcoin's going to 50k next week, what happens then? I, like everyone, have an ego, and I'm saying this to thousands or millions of people on Twitter, potentially, and thousands of students in HU. If I say and nail my flag to the mast saying that Bitcoin's going to 50K next week, I then have put pressure on myself as my reputation as a trader and a professor for Bitcoin to go to 50K, an asset that I have no control over. So by predicting that, what does that do to me subconsciously? It makes me look for every possible reason why Bitcoin will go to 50K instead of keeping an open mind and, like Rule 33 says, adapting to the new market every minute. So do not make predictions. It's okay to say, have thesis where you say, if price does this, then I think we can go to this level. But on the flip side, if price reacts this way, I believe we could go in the opposite direction, and have multiple different scenarios and then weight them probabilistically. That's what bias really is. So a bias allows you to weight it as a probability, and most importantly, it allows you to change your opinion without having to admit being wrong. Nobody likes to admit they're wrong. It's an ego thing again. So if you predict something, you will be right or wrong. If you have a bias, you can never be right or wrong. No one can ever accuse you of saying, but you told me it was going to 50K. You mean, no, I said, I'm about 70-80% sure that we should go to 50K if this set of factors happens. Therefore, there is a 20% chance that we don't. But those odds are good. If it's 80% likely per my analysis, then it's a good trade to take. But that still means that 1 out of every 5 trades is going to lose. And that's totally fine. You're not here to make 100% win rate. You're here to make a high enough win rate with good enough risk management that you can be profitable over time. So, rule number 34, focus on bias, not prediction. Rule 35, the 1 minute rule. This is super important. If you're entering a trade and you see, price moves down to whatever level you want, or you see a candle moving in one direction, or something happens, there's a bit of news, whatever. You have an impulse, which is very normal and natural. You have an impulse to enter the trade. Right now is never the best entry. Keep that in mind. How many times have you entered a trade and immediately price has gone exactly in your favor and just never looked back and went all the way to profit target? I have been trading for years, thousands of trades. That has maybe happened a handful of times, if even. Right now is never the best entry. So even if you get a trigger, even if you get a setup, or if you see some news especially, or something that would make you potentially have FOMO or react in emotion, just wait a minute. Have your trade ready, have your 0.5 BTC inputted, have your stop loss ready to set, and do nothing. Just stop yourself and say, okay, I'll put it on in a minute. A minute will never break you. A minute will never kill you. Right now is never the best entry, so just wait. Now that's easier said than done, but again, the whole point of this is that you should try and train these things into yourself over time. So just set, a rule for yourself, write it on a piece of paper on your board in front of you so that it's always there, stick it to your screen, the 1 minute rule. That alone will make you a better trader if you take nothing else from this lesson. Rule 36, scale in, scale out. The most important thing to note on this is that there is no best way to scale in or scale out. So just to quickly cover what scaling is, scaling into a position means not putting on 100% of your position at once. So if you trade 1 BTC, that's your full position size, scaling in would mean you put on 0.5 BTC now, you let price develop for a bit, you put on another 0.5 BTC, then you're fully filled. You'll see me talk about it a lot in HU, where I say entered a quarter, entered a half, entered a third, entered another third, fully filled. Entered a quarter here, entered another quarter, decided to leave just a half position or whatever. It always changes. A lot of times I get questions saying like, how do you scale in? What should I do? Should I do 25, 25, 25, 25, 50, 50, 33, 33, 33? Again, don't be autistic. This ties back to the 1 minute rule. There's no rush, even in scalping. There's no rush. You can always wait. Even if you want to enter now, enter a quarter, enter a half. Wait a minute, wait 2 minutes, enter the rest. Just see how it develops. There is no best way to scale in or out. It's the act of scaling itself that makes you a better trader by default. Bad traders enter on emotion, with 100% position size. Even if you enter badly, if you execute poorly, but you execute 25, 25, 25, 25, you're immediately ahead of the worst traders on the platform. And remember that trading is a player versus player game. For me to win, someone else has to lose. So if you can just do that one little thing, it will make you a better trader immediately. Now don't get caught up in how. Just set it for yourself. Just say, okay, I scale 50-50 all the time, or in thirds, or in quarters. Just pick one. Completely arbitrary. Just pick one of them and stick to it. It's a better mental model. Rule 37, doubles are better than singles. This refers to confirmation of a trade. All right? There's not really anything more to say on this. So I've put a chart on the screen to illustrate it. If you were to enter a trade, you can wait for one confirmation per your rules, or you can wait for two. It's always better to wait for more confirmation. So, again, always using the example of the under-over and over-under. In this example, we have a high that was set, and then price traded below it for quite a while, then it ran the high and reversed. So the yellow line is the high, and the dash I've drawn here is the left shoulder, the over-under, what do you call it? We then run it, we put the head. The line here is the market structure line, so this is the low. I know it's hard to see, but I have to zoom out for the purpose of the image. This is the most recent low before breaking the high, okay? So this low broke that high. Then, when we trade back below this low, we consider that a break in market structure. When market structure breaks, we are then looking for the same pattern to form again, bounce back up, and you can see here, this red line was the high it set, shoulder, broke above it, back below, broke below this line, which again was the low that led to that, traded, chopped around, bounced back up, done a perfect right shoulder on the over-under head and shoulders pattern, and then promptly sold off. You're looking to exit. If you're looking for a double confirmation, your perfect exit is basically anywhere above this red line and below this red line on this bounce. So anywhere in here, you could have entered the trade and had a double confirmation of your setup. And also, I know this is scalping, but people think, yeah, but in the moment, you can't see that, it's hard to do. It's all pattern recognition. So yes, you can do it. Just study the charts more, focus more, develop your pattern recognition. Pattern recognition is not an inherent skill. We do inherently have pattern recognition ability, but you can absolutely improve it. Okay? The more you study anything, the better you get at it. And if anyone's saying, but this is a 1 hour chart. So each candle is 1 hour. So when you broke back above this line, I know it's hard, we're not zoomed in, but you can see that there's probably 10 or 12 hours that you had to execute this trade. And then look at the payoff. Look at the lovely short all the way down. So don't listen to anybody who tells you that this is not possible, or it's just people are just trying to justify their entering on FOMO. So doubles are better than singles. And that's one that's more to work on. Again, the focus of execution should always be mechanical. But when we're talking about these discretionary factors, these are the things that will, over time, make you a better trader. You don't always have to action them, but if you always look for them and just note it down and say, oh, okay, I saw that, great. And finally, rule 38, you need to have invalidation within invalidation. All right, so here's a nice example, and this is a common one for students and people who ask me. At the start, we got a nice long entry, again using the under-over. So we had the under, the shoulder, head, shoulder. We ran the low, we broke back above the dotted yellow line, we broke back above it, we then formed the same pattern and we tagged that line again. So if you entered here, you're in a long. Where does your stop loss go? Below the low. And that's why it's down as your initial invalidation. Then price moves up, and the white lines that I've drawn are the respective highs on the trend up. As you can see, this is very clearly a trending move, okay? When we have a trending move, what you're looking for are higher highs and higher lows. That is the very definition of an uptrend. High, and then it forms a higher low. Then it breaks higher again. Then it forms another higher low. Then it breaks up again to form a higher high. Then it forms a higher low. Then it breaks up again, and so on and so on and so on until the trend ends. So invalidation within invalidation means you enter the trade here and you let it develop. You wait. Again, this is a 4-hour chart, so you wait a few hours, you wait maybe 24 hours, and then price breaks up above this high. So in this candle, it breaks above the high and then chops around a bit. What happens then? Well, as each new high is made, this new high, so price has broken up to here. This was the down candle that led to it. So this down candle has broken structure bullishly, and if the trend is going to continue, this low will not get taken. Otherwise, it would not be a trend anymore. All right? So you can move your stop loss up, your invalidation up, move up as structure breaks. So as structure breaks bullishly to the upside, you can move your invalidation up. You don't have to move your stop up, but at the very least, set an alert at this level, meaning if price trades through it and doesn't immediately reverse, sometimes it will wick it just to grab some stops. But if it actually trades through it and is chopping around here, close your trade, take profit. The trade's invalidated, okay? Or if you're not going to be at the computer, which is less relevant, this is scalping, so you should be at the computer, but if you're not going to be, then move your stop up to here. Set an alert at the next high, which is this one, and when price breaks through it here, you get an alert, and it says, structure broken bullishly, move stop up. You move your stop up to where the new dashed line is, move up each time a new high is made. Again, as price keeps breaking up, your invalidation keeps breaking up to the low which led to that break in structure. Here, the bottom of this candle, which led to this break in structure, move the stop up, and up, and up, and up, until eventually you get stopped out, which is here. So eventually you'd set your stop loss here, we broke up, we did all of this shit, dropped back down, eventually stopped you out and did whatever it was going to do. But look, from a trade that initially had an invalidation here and an entry here, you got a trend all the way up and you eventually got stopped out here, but that's a great move. You got all the meat of that move instead of leaving your stop arbitrarily down here at the start and then waiting for price to break. And then if price broke, what do you do then? Do you wait? I've seen a lot of people, and myself included when I was less experienced, that have let this entire trade completely reverse on them all the way back down till they ended up break even or even getting stopped out for a loss. So, Rule 38, focusing on some discretionary, is to have invalidation within invalidation. You can actually make invalidation within invalidation mechanical and non-discretionary, but the act of moving your stop loss itself is discretionary. Even though everything I said here is completely rules-based, because it's an if-then. If price breaks above the high, then I move my stop up. If price breaks above a high and continues the trend, then I move my stop up. So if it's ever an if-then, it's mechanical. But humans are humans. The very act of you pulling that stop loss up on the exchange interface is discretionary, so it falls under discretionary. But if you're focusing on one discretionary tactic to use, this is probably the most mechanical one of all. Right? So that's everything you need to know for execution. To sum it up, focus on the mechanical side first. Entry, stop loss, profit target. If you're a new trader especially, just do that for hundreds of trades. Just do it. Just get used to doing it. Get used to not fucking with your trade. Get used to not moving your stop loss for a while and observe what happens. Over time, you'll become a better trader, and you'll then get to introduce some discretion, such as your invalidation within invalidation, or double confirmations, scaling in, scaling out, the 1 minute rule, bias not prediction, all of that kind of stuff. Okay, so this is the execution module finished, 2.4. Next, we're going to move on to the stuff that everyone loves, which is the price action, the patterns, the charts, all of that. But really ground yourself in modules 1 and module 2. about all about the psychology and the execution in markets. And get yourself ready, because we're going to jump into the price action and then some of the indicators and techniques, and then building systems next. Thanks.